Central banks like the Bank of Canada as well as the Federal Reserve keep talking about how they have to lower interest rates, but there's a really important key factor that they're missing out on what needs to be done to lower inflation. If you're one of those individuals who are looking for a real estate crash with higher interest rates, be careful what you wish for, because with having lower interest rates, lower inflation, and impact of the real estate market as a whole is going to impact you in other ways you didn't expect. Central banks like the Federal Reserve and the Bank of Canada continue to talk about how rising interest rates are going to impact and lower inflation, but there's a very important underlying thing that needs to be discussed here. Before we continue, I'm Josh Tavares, investor and realtor with the eXp Realty Brokerage. It'd be so amazing if you can help us out and hit the like button, hit the subscribe button, and hit the notification bell to get updates on our newly uploaded content. And if you guys want to learn more about our real estate investment toolkit course that's coming out soon, check the description and comment down below and learn more. Without further ado, let's begin. Everyone right now is looking for inflation to drop, which unfortunately has an impact of higher interest rates. However, inflation may not be the best indicator to watch at this time. There's another statistic that the Bank of Canada and the Federal Reserve stopped talking about a little while back that we have to get back to. During the pandemic, this point was actually a primary discussion point in the beginning of the pandemic, and this is the unemployment rates. Do you remember when the Bank of Canada as well as the Federal Reserve mentioned that they wouldn't increase interest rates until the unemployment rates increased? Now, full employment is full effect. However, we're having higher inflation than we've had for many years. Supply chain issues as well as pandemic related concerns are some big factors impacting our market today. But in this current time, we have too many people being employed, and that's significantly impacting our economy today. In economics, the relationship between inflation as well as unemployment rate is called the Phillips curve. The Phillips curve suggests that there's an inverse relationship between inflation and unemployment. In other words, if you have high unemployment, you have low inflation, or if you have low unemployment, you have high inflation. Currently, unemployment rates are at historic lows. For inflation to decrease, we need unemployment rates to increase dramatically. Higher unemployment rates will actually lead to lower inflation because there'll be less borrowing taking place and less spending in the overall economy. It's important to note that during recessions, these information holds true. To lower and higher inflation periods, that means unemployment rates need to rise. This means if you're hoping for higher interest rates to lower inflation, that's not essentially going to work that way. What you're looking for is having more people unemployed to keep the rates of inflation lower. More than 5% of the job market is going to be unemployed, whether it's going to be people entering or leaving the job market. So what does this mean for the average person? So if the Bank of Canada and the Federal Reserve are going to go about increasing interest rates, it's not necessarily meaning that by paying higher interest and paying more for your loans, you're essentially going to have lower inflation. To significantly decrease inflation, you need more people unemployed in the job market. And by having more people unemployed in the market, you're going to have more implications taking place in the overall economy as a whole. This will essentially lead to less spending, less borrowing, making it more and more difficult for certain businesses to survive and more essential-based businesses to do well based on the recession and everything taking place. So just something to keep in mind for yourself. Less spending, less investment means a reduction in the economy, which impacts everyone, including jobs, inflation, interest rates, and everything as a whole. To summarize, increasing interest rates is not going to be enough to decrease inflation, because at the end of the day, a bigger indicator is going to be the level of people who are unemployed, and to have that number come down in inflation, you need more people unemployed, which means the economy is going to suffer, which means less people are going to spend, which is going to impact many different jobs, investments, and impact many markets, economies as a whole, and lead to a bigger recession and possibly a depression. I hope that was super helpful and insightful, gives you everything that you need to know about what needs to be done to decrease inflation and not necessarily just raising interest rates. I'm Josh Tavares, investor and realtor with the eXp Realty Brokerage. It'd be so amazing if you can help us out. Hit the like button, hit the subscribe button, and hit the notification bell to get updates on our newly uploaded content. Thanks so much for watching. Again, take care.